Very happy Wall Street. The Dow is soaring into record territory after Federal Reserve Chair Jerome Powell forecast changes could be on the way. Listen.
Risks to inflation are tilted to the upside and risks to employment to the downside. The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
So the media believes that Powell has confirmed it, that rate cuts are coming. Now here's what nobody's telling you. In fact, these potential rate cuts could actually trigger a market crash. And if you're not ready, your portfolio could be in a lot of trouble. And if that wasn't enough chaos, there's political pressure also heating up. Trump is even trying to fire the Fed governor, Lisa Cook, and she's actually refusing to step down. So the Fed is in turmoil, the markets are ultimately on edge. So how do you protect your money, even your profit, from all of this chaos? Today we're going to run through stocks that could not only survive but thrive during this potential rate cut crash. We also have to make you aware, as we're heading into September next week, it is historically the worst month in the S&P. And if we just take a look at historical performance across the S&P, both when considering a recession and one without, in the 12 months after we're seeing this cutting cycle, the S&P itself has been down negative 4%, so not a massive amount, but that is when not considering a recession, and when one is in play, we're talking double-digit negative 16. But we should also point out that many analysts have really been cutting their expectations, the probabilities of a potential incoming recession. Goldman Sachs not long ago dropping it down to 30%, and the Wall Street Journal actually surveyed 69 different economists to see, as of today, whether they believe a recession is inbound, and many of them, whilst previously we're talking just April, although that was during Liberation Day, did have over a 50% expectation. Many of those have lowered them down. We're talking on average in the 30%, very similar to Goldman, but that doesn't necessarily mean there isn't one inbound. It's also fascinating just to look at analysts right across the board. We're seeing green. Now this is a scale of 1 to 5, 1 meaning analysts are saying these companies are a strong buy, you must in fact add them today. 5, which is red, would be a strong sell, and the message is very clear. Analysts are saying buy, buy, buy. We're talking lots of stocks which, as we will highlight, do look severely overvalued. And this is a message also shared by Mr. Bullish Tom Lee, who whilst anticipates a drop coming soon, perhaps in line with the September seasonality, believes new all-time highs are just around the corner, and that is something also shared by Morgan Stanley. In fact, we just saw analysts pretty much believing every single company in the S&P is a buy right now. Now, just going back to history, we can see the US has experienced 7 rate cut cycles in the last 50 years. On average, they've lasted just over 2 years and seen a drop by around 6.35 percentage points. So what does that mean during these rate cut cycles? If we just look at 3 different asset classes, we're talking stocks, bonds, and real estate. During the rate cuts, which we anticipate will be very soon, stocks themselves were down around 6%. We can see the same applies to real estate, down just under 5%. And remember, we just highlighted on average, these cycles last just over 2 years, some a lot longer, some less, with the outperformer in this being bonds at around 6.3. Now we can also take, once the cutting cycle is finished, ultimately we have stocks, bonds and real estate all performing very well, but quite interesting to note that REITs typically outperform, something that we will cover too. But perhaps we don't get a market crash, maybe we get a dip or a correction, and you can see this being justified because when we look at the market, this is on a forward P basis, so we're looking at the earnings expectations over the next year, even incorporating all the growth that a lot of these companies are anticipating. We still see a lot of red, we still see overvaluation, and for companies that maybe we should incorporate their growth, we're talking Nvidia, we're talking Amazon as well as others, they still look to be a little bit out of place when we have a conversation about undervalued companies. The only caveat that we would say here is lots of them, when looking at their earnings per share projected over the next 5 years, are expecting a massive amount of growth. Now, no one has a crystal ball, so this is really dependent on the economy not only staying as strong as it is now, but keeping up that momentum. And on a historical basis, their revenue has also increased fairly strongly, but that doesn't apply to a lot of companies. So we're actually seeing high valuations. Yes, earnings per share is expected to be strong. but historically, if we just take their revenue, not all companies have actually been growing. Now today we are going to cover some stocks that we believe will actually outperform with the anticipated rate cuts coming, but also worth flagging that REITs, as we mentioned before, have historically been one of those outperformers, and in fact stronger than the equity market. We're talking over the next few quarters, quite a significant disparity. And before we jump in, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks as well as what's going in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Stock number 1 is ARE, the REIT specializing in life science and biotech lab spaces. Now they're down 34% in the last year. That was down to higher rates as well as sector risk. Year to date, they're also down around 18%. And if we look in the last 5 years, this is one that has continued to be battered. Now with Fed cut rates on the horizon, as we've discussed, we expect a strong rebound, not just an attractive yield that sits above 6.5%, but also growth potential. They're trading towards the lower end of the 52-week range, quite some way away from 52-week high at $126, where we get a strong buy rating from Seeking Alpha and a buy from Wall Street. Now their forward price to adjusted funds from operation of 11 is significantly lower than the 5-year of 19. Yield very high, 6.6, when historically it's been at 3.5. Both of these are a severe undervaluation signal, and we should make it clear dividend does look to be safe with a 76 score, something important especially when the yield is having massive disparity from the average. They also increased their dividend around the inflationary rate, which isn't too bad considering the very high yield. And when looking at high yields, a couple of things to bear in mind. First one, how is their AFFO payout? Now below 90 is what we want for REITs, consistently below that, so a great sign, expected around 73 in the next year. And the other thing is the net debt to EBITDA. Now for REITs, we do want to see this ideally below 5.5. It is estimated to creep up just below 7, so this is one area that we would say to keep an eye on and why we like a fairly high margin of safety. The valuation also, when incorporating the blue tunnel, does show undervaluation, disparity between where it sits today and the bottom end. Remember, the parameters here do indicate the fair price. Not the greatest to see intrinsically it has been decreasing, but this is something we've only noticed in the last few years, so with rate cuts potentially coming very soon and quite a few, then this is one that could in fact have a very nice rebound. And speaking of valuation, when we compare their price to adjusted funds from operation, it sits around the 11 mark. It is trading at quite a significant discount to the sector, we're talking around 30%. It's also an institutional favorite with 97% ownership. They sold $2.7 billion in the last year, buying more than twice as much at 6.2, and we've noticed that again, same scenario in quarter 2, institutions are net buyers and they have been adding. It's also one that we have discussed in our latest newsletter, so if you want a bit more information around why we do like this as a potential great play, not just on the dividend but also growth, then do take a look. Now our intrinsic price for ARE does come to $116. Typically deeper dives we run through each one. Just getting straight to it, you can see quite a lot of disparity between the intrinsic price and the value today. That gives rise to a 30% margin of safety. Definitely one to consider with rate cuts coming. Also factor in money that is either in the sidelines in high savings account. As that does start to drop, income investors may start to look at REITs that do offer very high yields. It's also one that Wall Street themselves like. They see this at $100 into next year. That is around 23% upside. So let us know stock number 1, ARE, if you see this as a buy, hold or avoid. The next one we'll look at is Intuit. Now they're the company behind TurboTax, QuickBooks, Credit Karma, and a leader in financial software that in fact individuals and millions of businesses rely on. Now they're up around 6% in the last year. Year to date, they're not the best, only up around 4.5%, but over the last 10 years, they have massively outperformed. Now, with the AI integration that they're having across their platforms, steady growth as well, they're well positioned for long-term expansion, with Feds again cutting rates, boosting potential consumer and business confidence. They could be a major winner. Now, they're trading towards the lower end of the 52-week range. We do get a double buy from Wall Street and Quant, although a hold from Seeking Alpha. Wall Street 4.38, very close to a 4.5 to flip that into a strong buy rating. And they also released their earnings not that long ago. Sales were up 20%, but the kicker, as always, are the guidance. Analysts want to see nice growth, and it came in a little bit below estimates, and that is why we got a sell-off, potentially giving us a good opportunity to consider. And one thing that investors maybe didn't see is that they've also approved a new share buyback program. Great to see, especially when the yield isn't that high, so one way they can return excess cash to investor pockets. And we're also seeing an undervaluation signal with the forward P of 28 that is below their 5-year historical 34. And even though the yield is fairly trivial, we will just highlight the dividend does look to be very safe, with a double-digit increase just this month, over 15%. And also, when we do take a look at the blue tunnel methodology, it has just slipped out, so another undervaluation signal. If we were to zoom out over the last 5 years, this one actually periods where it's been severely overvalued, also severely undervalued, and in fact in a reasonable signal. Right now though, potential opportunity, and that is why we say have the notification bell on, because when we see high quality companies that do look undervalued, we will flag for your attention. Now, we can also see their latest full year numbers where revenue was up 16% year on year. Always great to see, in my opinion, companies that can improve their margins. Gross profit up 1 percentage point, operating up 4, bottom line up 2. And one of their largest income streams, the QuickBooks revenue, has been growing at a 24% CAGR going back to 2020, whilst they've also been able to increase their free cash flow at 15% year on year. That is very impressive, because when we run it through the DCF model, we are going to be a lot more conservative. And they also anticipate over the next 4 quarters, each one of them to be double-digit growth. We can see they've got a 100% historical track record as well, and it's also an institutional favorite, 84% ownership, 17 billion worth of selling, a lot more buying at 28 billion. They bought around twice as much in the most recent quarter, and actually if you wanted the reverse of the trend, you'd have to go Q1 2024. More often than not, institutions continue to load up on Intuit. Now, our intrinsic value gets to just under $800, one model, so we can just go into it and explain how we arrived. We've got their latest free cash flow amount. Average growth, 24% year on year. We've gone 12% to be a lot more conservative, and as highlighted earlier, going back the last few years, it was around 15%. We have a low, medium, and high growth rate, 10, 12, 14 respectively. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Intuit, or any others. But baked in on a reverse DCF, we have 9.2% growth. If you believe that is already very low, then straight away, potential undervaluation, and vice versa. So with the growth rate and the discount rate, we're getting the present value of future free cash flow terminal price, where we add together with the cash, subtract total debt, get to the equity value, and we can see 797, indicating 21% upside. If you want to be more conservative and for transparency, at 10%, 691, upside of 5, and for those that are a lot more optimistic and believe we should be coming a lot higher, we're at 14, 919, 40% upside. As always, taking through the middle rate today at 12%, maybe not a 30% MOS that we saw from the REIT ARE, but 18% on a high quality company could be one for consideration. If you're on a 25% MOS, well, a buy just under $600, and Wall Street themselves see this at 836 into next year, 27% upside. Stock number 2, Intuit. Let us know if you see it as a buy, hold, or avoid. We then move on to Marvell Technology, which designed high-performance chips for AI, data centers, and 5G. Now, the stock hasn't performed the best in the last year. They're up only 1%, but really with lower interest rates, this could be a big tailwind. Rate cuts do, in fact, typically lift growth tech valuations, making it cheaper for cloud providers to invest in expanding AI and data infrastructure. As we said, not the best performer. They are down 1/3 of their market cap, wiped out this year. Over the last 10 though, they have been outperforming the S&P, trading very near to 52-week lows with not only a double buy from seeking alpha in Wall Street, but Wall Street very close to 4.5 for a strong buy rating. And we're also seeing their data center segment continue to rise, CAGR 41% going back to 2020, and the valuation also looks good. Forward PE below 25, historically a lot higher at 35, and we're also getting a very attractive picture here. The intrinsic price increasing in the last 12 months, the stock price doing the opposite. This is where opportunities arise, and we're seeing here disparity, so that is why we would say a nice undervaluation signal, something that does appear over the last 5 years, but also the intrinsic value is a little bit inconsistent. But we love their growth historically and expected. We get an A-, last year top line up 22%, expected there or thereabouts this year. Not only is that above the sector, but they're also growing faster than they have done historically, and that also encapsulates the earnings per share, projected to grow 36% in the next 3 to 5, well above sector at 15 and their own historical of 26. And green right across the board. We love to see this. Triple digit expected to the earnings per share next quarter, subsequent 3 double digit, 100% track record. And if we look to their next full accounting period, well, they're trading at a forward PE just below 21. Another institutional favorite with 84% ownership, selling 11 billion. They've bought more at 16 billion. The same thing we note in Q2. In fact, more than 3 times that buyers of sells. Reversal of the trend Q1 2024, but again, very often institutions are net buyers. And our intrinsic value at $102 is derived using a growth rate of 15%. Baked in now, we're talking below 10%. If you think this is actually way too conservative, well, at 20%, we're talking below 140. That is nearly a double from the current value. So using the middle rate of 15%, we are getting a very, very respectable MOS of 28%. Wall Street also very bullish. We said near strong buy rating, $92. They're estimating 26% upside. If you wanted a bit more, well, at 35%, a buy around 66. But let us know your views on Marvell Technology. We then move on to Mondelez. They're the maker of Oreo, Cadbury, and Ritz, the global snacking giant, and they typically have steady demand regardless of economic cycles. Now, they're down 13% in the last year. Year to date, they're not doing the greatest. They are up just about 3%. But realistically, with cost pressures and consumer spending worries, lower interest rates could really provide relief, which will in turn translate to stronger consumer confidence. They're also trading very near to 52-week lows. We get another buy, but just solely from Wall Street, not far off the strong buy at that, where their forward valuation 19 is below the 5-year of 21, yield 3.2, quite high in comparison to their historical 2.3, and the dividend does look to be safe at a score of 66, where we notice the free cash flow payout is sitting typically around that maximum threshold that we want for consumer staples, expected around 72% in the next year. And good to see no real worries on the net debt to EBITDA, below 4, and in fact has been declining from the highs of 2017, estimated 2.5 over the next year. And we also get a potential undervaluation signal. It is sitting right there towards the bottom of the blue tunnel. And in fact, when we zoom out to the last 5 years, this is one that typically does trade in its reasonable place. Now, they are expecting their next quarter to be a drop for the EPS, but the subsequent 3 looking very strong with a 100% track record, bare minimum in line. Next full accounting period estimated their forward P to drop below 19. And another one institutions are bullish on, 78% ownership, selling 7 billion, buying around 50% as much in the same time frame. They bought a lot more in Q2 than they sold, a trend that is pretty much seen more often than not. Again, you'd have to go Q1 2024 to see the reversal, but as we can note, more often institutions are in fact net buyers. And our intrinsic value, just under $74, gives rise to a 17% margin of safety. One Wall Street like to $76, upside of 25%. You're also getting a yield above 3%. And for those that wanted an MOS of 20, or to make note, a buy at $59 at 25, sitting around 55. Let us know your thoughts on the 4 stocks as well as Mondelez if you see it as a buy, hold, or avoid. And don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.